This exact trading approach helped me generate $17,839 in the last 30 days. And the crazy part, it's not complicated. In this video, I'm going to show you a professional way to trade momentum step by step, where you wait, where you enter, and where your stop goes, and how to choose realistic profit targets. By the end of the video, I promise you'll be able to open a chart and practice this immediately. Let's jump in. First, we need a strong move, big candles, clear direction, momentum that's obvious even to someone new. Why is this important? Because expansion tells us one side of the market is in clear control. Pressure is overwhelming the other side. But here's the key. We are not trading yet, we're observing. The mistake beginners make is they see power and jump in. A fast movement usually creates exhaustion, and exhaustion usually leads to a pullback. So instead of chasing, we prepare for better price. After expansion, the market typically retraces. This is normal. It's the market resetting after an aggressive movement. Early participants take profit, new participants wait for value. Momentum cools. And this is where professionals get interested. Think about real estate. No serious investor wants to buy a 6-figure or 7-figure property at full retail. They want it discounted. Maybe 50 cents on the dollar, maybe 70 cents on the dollar. Why? Because the difference between what they pay and what it's worth becomes equity. That equity is protection. It gives us room for mistakes, it gives us room for time, it gives us room for profit. Trading is no different. If you enter at the emotional peak of expansion, you paid retail. There's no cushion. Any normal pullback can put you underwater. But when you wait for price to come back towards value, now you're participating at better pricing. Your risk shrinks, your opportunity expands. Now we ask a smarter question. If the side in control is still strong, where should that strength show up again? This could be a breakout level. Previous resistance turns support. A consolidation move before the move. A clear reaction point. What matters is logic. We want a level that, if price breaks beyond it, it's going to tell us we're in the wrong. Because if we know we're in the wrong, we can control risk. Now you have structure. Price reaching an area is not the signal. Location gives you permission to pay attention. It does not demand entry. Most traders lose because they treat touch equals trade. We want participation. We want to see that the side previously in control is responding again. What can that look like? A strong rejection. Failure to continue past the level. Momentum attempting to return. Price holding and stabilizing. Instead of predicting, you are asking the market to reveal intention, because now your trade has evidence behind it. Proof. And proof is what allows you to risk money calmly. Once confirmation appears, now we can talk about an entry. We're executing a plan. Some traders enter at the close of the confirmation candles. Some wait for a small retrace. Some enter on a break, showing strength is returning. The method can vary. What matters is the logic, and you are aligning with that return of control. Notice what you have avoided by waiting. You have avoided entering at extremes, you have avoided oversized stop losses, you have avoided uncertainty. Instead, you entered where risk is defined and evidence already exists. This is repeatable. Now we get to survival. Your stop loss must sit at a point where your trade idea becomes invalid. We entered because we believed that area would be defended. So if price breaks through that defense with strength, what happens? Control shifted. The reason for the trade disappears. We exit, no negotiation. Practically, that usually means placing your stop beyond the pullback extreme, beyond the rejection. We're slightly past the structure expected to hold. Some traders add a small buffer for normal market noise, that's fine. But if the levels fail, the thesis is over. What you're doing here is powerful. You're defining the loss before the trade runs. So when movement happens, the emotion doesn't control you. The decision is already made. Now we talk about getting paid. If continuation is real, price is likely to travel towards meaningful areas. Usually those look like previous highs. Liquidity pools. Zones where reaction happened before. Market tends to move between decision points. That's where targets come from. But here's the professional layer. Trading is not about being right every time. It's about risk versus reward. Because we waited for pricing, our stop is tighter. So imagine you risk $100. If your target is $200 or $300 away, you can be wrong several times and still grow when the winner arrives. Now math is working for you. Patience created that advantage. Better entry equals to smaller stop losses equals to larger potential reward. That's edge in the market. Here's the model in order. Number 1, strong expansion. Number 2, wait for retracement. Number 3, identify the level that should hold. Number 4, wait for confirmation. Number 5, enter with logic. Number 6, stop at failure point. And number 7, target realistic objectives. Now you're operating instead of reacting. Will it win every time? No, nothing does, but losses will make sense and winners will be planned. Most traders act first, justify later. Now you have reasons before risk. That changes everything. If you want help turning ideas like this into a complete system you can follow every day, there's a link down below to talk with my team. And if you want to keep building immediately, check out the other videos popping up right next to my head. Those will show you how professionals manage positions after entry. And if you guys enjoyed this comment, please go ahead and like the video, subscribe, and drop a comment down below what was your favorite part and if I should do more videos like this. But with that being said, clarity beats confidence every time. Good luck, snipers.